Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. Naked short selling. Many investors and traders of these two precious metals tend to certain financial institutions, particularly bullion banks, of naked short selling in order to put downward pressure on prices. But does naked short selling mean? Short selling means selling something you don't have. So if you talk about short selling gold bullions, it means you're selling gold bullions you don't have yet. Now, why would you sell something you don't have yet and get into a whole lot of trouble for it? After all, isn't selling something you don't have considered fraud? Well, not really. You may not have the gold bullions yet, but you can borrow other people's gold bullion to sell them. And when the price of gold bullions drops, you can buy the same amount of gold bullions you borrowed for short selling and in the process, make money. This type of short selling is called covered short selling because you cover yourself by first borrowing enough gold bullions to sell. Naked short selling is uncovered short selling, i.e., you sell the bullions you don't have even when you haven't borrowed any to sell yet. Naked short selling also happens when you short sell gold bullions without any guarantee from other people that you can borrow enough bullions for short selling from them. Naked short selling can put you or any trader who does it at high risk of not being able to deliver the gold bullion sold to the buyer. Thus, the potential impact of naked shorts can be very serious. There are rumors or urban legends that accuse the federal government of using bullion banks to execute tons of naked gold short sales on the commodities exchange on its behalf to suppress the price of gold, maintain the US dollar's value, and gives these bullion banks the opportunity to make huge money by repurchasing the bullions at lower prices. Sounds so evil and believable, right? But think about this, if the number of naked short sellers and their naked short positions were that significant, the drop in prices of gold would be so huge that it would generate a reciprocal spike in demand for it. And the huge spike in demand would just wipe out the price drop because of the law of supply and demand. Another thing to consider is the practicality of executing huge amounts of naked short sales just to suppress or manipulate the price of gold or silver. To execute this strategy effectively to drop the price of these two precious metals, naked short selling institutions would have to purchase a huge number of futures contracts just to cover their naked short positions. And as the futures contracts mature, they'd either have to buy the actual amounts of huge metals per futures contract bought or roll over their positions, buy contracts that will be expiring, and flip the next ones out. In either case, the institutions involved in naked short selling for price suppression will need to eventually unwind their positions, which will ultimately reverse or neutralize any price suppression effects of their attempted naked short sales. And this explains why naked short selling for price suppression isn't realistic and why you'll see that based on long-term price charts for both gold and silver, their values follow cycles or patterns. The main point of it all is that, despite the many conspiracy theories of price manipulation for gold and silver, proof of such is lacking. As for all financial assets whose values are market-driven, there are bull and bearish markets over the long term. Bear markets or when prices are falling don't equate to price manipulation any more than bull markets when prices are going up do. It's all about market demand, cycles, and the ability to time our transactions well.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye-bye.